If you're buying and selling options contracts or considering adopting any sort of option strategy, you need to know about the skip strike butterfly approach. I know it sounds like a weapon your kid might get in Fortnite. However, this complex but ultimately lucrative strategy can drastically change your income potential while giving you yet another powerful tool for your trader's tool belt. In this video, I'll go over the skip strike butterfly with puts strategy in detail while covering the pros and cons. So let's get started. Thank you for watching this video, but before we begin, if you could, please take a minute to subscribe to my channel. And if you enjoy this, make sure you hit that like button. Also, if you know someone interested in options, please feel free to share this video with them. Now let's get started. Let's get started by discussing precisely what the skip strike butterfly strategy is. Now some people call this a broken wing or split strike butterfly, but they all refer to the same basic approach. Essentially, it's an option strategy consisting of three different put positions. The goal is to put you in a position to profit from small downward movements in the stock price while simultaneously limiting potential losses from any upward movements. As you probably figured out from the verbiage alone, this is quite similar to a skip strike with calls. However, by focusing on puts, we're specifically trying to profit from downward movements in stock price. If you're a more experienced options trader, you might want to think of this as embedding a short put spread inside a long put butterfly spread, where you're selling the short put to pay for the butterfly. If that sounds confusing to you, don't worry. We will provide a lot more information as we dig deeper into the strategy itself. As I mentioned a moment ago, the skip strike butterfly is a position consisting of three puts. These include a long out of the money put, a short at the money put, and a long in the money put. Now, for the sake of keeping things brief and covering as much trader terminology as possible, I'll sometimes refer to these by their abbreviations: OTM, ATM, and ITM. Now let's go over each one in a little more detail. Your long out of the money put is the first leg of the strategy. Put simply, you're buying an OTM put option, which gives you right to sell the underlying stock at a specific strike price. This puts you in the position to profit if the stock price decreases significantly. Now your short at the money put is the process of selling an at the money put option, thereby generating income from the premium received. However, as no trading strategy can be 100% foolproof, this also exposes you to potential losses if the stock price drops significantly. That's where your long in the money put comes in. This final part of the strategy involves buying an ITM put option, thus protecting yourself against these same large downward movements. Now that we know what's involved, let's talk about the distance between the strikes. In the skip strike butterfly, the distance between the two lowest strike prices, the long OTM put and the short ATM put, is twice as wide as the distance between the two highest strike prices, the short ATM put and the long ITM put. This uneven distribution of strike prices is what's going to provide you with profit potential while reducing your exposure. Now let's talk briefly about how this fits into the so-called three-legged options family. This is the umbrella term used to refer to the trading strategies that involve the simultaneous use of three different options contracts. These strategies have names like Iron Condor, which can make them sound like a military operation. And I guess if you're really serious about trading, that analogy is pretty apt. Again, what we're trying to do here is similar to the skip strike with calls, but with a focus on downward movement. This is in contrast to strategies like long spreads with calls and puts, which aim for directional price movements. The way most options traders see it is this offers higher risk, but also higher potential rewards compared to simpler strategies. In fact, this is a great time to talk about the pros and cons of the skip strike butterfly in a little more detail. After all, I never want anyone watching to attempt any new trading strategy without being fully aware of how doing so can affect them. In the end, you have to make the judgment when it comes to risk versus reward. So the primary benefit of the skip strike butterfly approach is that it's possible to generate significant gains from a relatively small price movement. As smaller movements tend to be much more common than massive runs and drops, this can be an enticing feature for any options trader. While you can earn quite a bit from having the price stay within the range of the two middle strike prices, you also don't have to worry as much if the stock price does surge upward. With the protective long ITM put, your overall losses are limited, but never zero. Finally, the skip strike butterfly is generally more profitable than vertical spreads, especially when the stock price in question behaves as expected. Other benefits include the overall cost efficiency compared to other option strategies, and the well-defined risk versus reward profile. As smart traders, we always want to have as much control over our risk as possible. The more comprehensive a view we can have, the faster we can react when making these crucial trade decisions. Taking all of this into account, let's talk about the disadvantages of the skip strike butterfly strategy for a moment. Now, depending on who you ask, you may get all sorts of different estimates as to just how risky this trading approach is. But it is important to remember that every trader's opinion is based on two things: their personal experience and their personal definition of what constitutes an acceptable gain and an acceptable loss. This is something to keep in mind whenever you listen to someone give investing advice, just like I am. If I lost my shirt on a straddle 2 years ago, it's unlikely I'd come out here and talk glowingly about the strategy. But someone who bought their second home from a lucky straddle might tell you it's the bee's knees. Just something to keep in mind. In all fairness, the skip strike butterfly carries more risk compared to vertical spreads, especially in volatile markets. This strategy can be rather complex, so novice traders with less experience with options pricing, implied volatility, and the mechanics of the strategy itself will sometimes be at higher risk than more experienced traders. Next, and you should expect this, you will see a higher impact from large downward price movement. Because the skip strike butterfly is mainly designed to offer protection against large upward movements, traders can suffer substantial losses if the stock price falls more than expected. So given these pros and cons, what situations are best for implementing a skip strike butterfly with puts? The way I see it, the ideal situation for maximizing your profit potential while limiting your losses is to find a stock whose price is either holding or declining slowly. I generally look for tickers with moderately bearish outlook because I want them to decline, just not dramatically. Other experts suggest looking for stocks that are anticipating limited price movement. This is a good way to establish predictable range. On the other hand, there are times when you absolutely do not want to use a skip strike butterfly approach. The big one is when there's an earnings release before the option's expiration date. We all know that earnings can generate huge price swings, and this is precisely what you're trying to avoid with this strategy. A more general rule of thumb would be to avoid using this strategy whenever there's a lot of volatility within a single stock or within the market as a whole. Volatility doesn't necessarily mean you're going to lose money, but it does increase your overall risk. Okay, now that we know how a skip strike butterfly with puts works, let's see how to open this position. First, let's take a quick look at JP Morgan Chase stock. This is a company I follow pretty closely, and due to its relative stability, I trade on this stock often. As you can see, right now it's trading at around $144 to $145 today. But it's been on the decline this past week, falling a little bit further each day. But if we go a little further out, you can start to see that there's been a little bit of a trading range that it's in right now. And if we go out even further, we can see that other than in mid-July when it peaked a little bit, it's followed a nice steady movement upward. I don't think the stock is going to fall much further, so this is a good candidate for the skip strike butterfly with puts. Let's go ahead and build the order. I've already entered the individual positions, so let's walk through this. First, I'm going to buy open one out of the money put, and that price is right around $1.60 or $1.61. Next, I'm going to sell open two at the money puts, which is going to bring in around $1.26 or $1.27 per share each. And then lastly, I'm going to buy open one more out of the money put that's double the distance from the short position than the first put. And as you can see, this one is going to cost around 60 cents. All three positions are puts, and all three positions have the same expiration date of September 29th. And all three positions are on JPM stock. All butterfly positions should be built with the same expiration date and on the same stock, always. The net result of this position is a credit of 13 cents per share, and with a contract size of 100 shares, that is a $13 credit at open. As you get more experience and are trading with a bigger account, you don't just have to do a 1 to 2 to 1 ratio. You can go up with a 2 to 4 to 2, or even a 10 to 20 to 10 to make this a bigger trade. You just need to keep the ratio the same. Of course, your risk amount increases the more contracts you trade at any given time, so know your thresholds. Now I like to use the Power E-Trade screen. Using this, I've gone ahead and built the same trade. Buy open a single out of the money contract, sell two at the money contracts, and buy one in the money contract. So let me go ahead and save this, and let's see what we got. This is the profit and loss chart for this position, and this horizontal line represents the stock price, either going down or going up. The first thing I want to show you is how the position remains profitable no matter how high the stock price gets before expiration. Essentially, all three options expire worthless, and you keep the net credit from the open. But it's when the stock price remains below the highest strike price that things get interesting. As the stock price falls below 145, your profitability increases until the stock price hits 144. It is at this point your trade has the maximum profitability, because at expiration, your 145 option is worth $1, but your other two lower strike price positions expire worthless. So above 145 is profitable, and below is even more profitable until the stock hits 144. It's below 144 that things start going the other direction, and when the stock gets down to about 143, this position is no longer profitable. Your losses will increase as the stock falls to 142, which is where your maximum loss will occur and will be capped no matter how much further it falls from there. This is why you don't want to open this type of strategy when there's a risk of significant fall in the stock price. If you open this position, you want JP Morgan stock to hover right around 144 to 145 or go higher, and you definitely don't want the stock to fall below 143. The last thing I want to show you are some quick numbers that E-Trade provides on this position. We opened this position for a $13 profit, but there is a profit potential for upwards of $109 with this trade. On the flip side, if the stock falls significantly, this position has a maximum loss potential of $91. And an important number to keep in mind, your break even on this trade is a stock price right around $143. To sum things up, the skip strike butterfly with puts has a lot of potential for new and experienced options traders. Just keep in mind that the goal here is to profit from slight downward movements in the stock price while managing risks associated with upward movements. If conditions are right and volatility is low, this can be a great way to boost your earnings. Thanks for watching. If you have any questions or comments, please post them below. And be sure to subscribe and hit that like button. Good luck with your trading.